Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon, or you can go to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much discuss whatever's on your mind. Now, that said, please remember this is just a show. Everything you hear should be considered informational, not financial advice. With me in the studio today is my colleague, Mr. David Franson. David, thank you for being here.
Hello, thank you.
David's going to be reading your questions, and I'm going to do my best to answer them. Now, you can send your questions in two ways. One way is by texting us to 913-363-1234. That's 913-363-1234. Or email us your questions to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, how can you make the claim that annuities have more growth potential than CDs or Treasuries? I bought an annuity and got an average return of 2% each year.
Okay, this is a classic example of cherry-picked data. So first off, you need to understand there are three types of annuities. The first one is a variable annuity. The variable annuity, it basically has all the risks, the ups and the downside. So you're going to get whatever you're invested in, the market ups and the downs. You're going to have multiple layers of fees. So you have a fee to the insurance company. You have a fee for the mutual funds that are typically held in there. There's often a pretty hefty 12b1 fee, and it's riddled with fees. Variable annuities only make sense, in my opinion, if you know the markets are only going to go up and you want guaranteed lifetime income in some sense. Very rarely do I find, I've actually never sold a variable annuity. I try to treat every investment or product equally. Variable annuities are often what are discussed in the, I hate annuities and you should too conversation.
All right.
Okay. So that's one. I've never actually sold one. I see what they're trying to do. I just have never found someone where it fit. The second one is a fixed annuity. A fixed annuity is like a CD from an insurance company. It's a guaranteed rate for a certain period of time. Got it. Okay. You sign up, you know what you're signing up for if you go into one of those.
Okay, yeah.
It's very, very simple, very black and white. You get it, and then you do something with it at the end. Okay. And then the last one here is a fixed indexed annuity. Now, a fixed indexed annuity basically says that if the markets go up, then you are credited interest, or basically the cash value would grow. And then if the markets go down, you don't lose any money. That's the gist of it. And so how can I make the claim that annuities have more growth potential than CDs or Treasuries? It's because of how it works. So let me break down an oversimplified explanation, because we're, through the radio waves, right? The audio streams of the interweb. I don't want to overwhelm anyone here in getting too technical, but here's just a simple breakdown. So fixed index annuities are basically a more complicated way to have growth potential with protection through an insurance company. It's all associated with a benchmark index. The benchmark index, if it grows, credits you money to your policy. And then if the benchmark index goes down, you don't lose anything. Okay, everyone with me so far? Hopefully.
What would be an example of a benchmark index?
S&P 500.
Okay.
There's the NASDAQ, FC, Bank of America has one that's in there. I mean, there's so many different indexes that could be out there.
All right.
And that can be a bit of a black box too. You got to understand the index that it is associated with and what the index can do. Some indexes are basically designed, and this is based on my opinion in vetting them, that they're not supposed to grow much at all. They're kind of supposed to just be steady Eddie, making 2, 3, 4% at best. There's some fantastic story behind it, and that's how they sell a bunch of them. So that's the first thing you need to understand. Now, all annuities can be used, fixed index annuities can be used in one of two ways. So you can use it as a lifetime income benefit where you transfer longevity risk to an insurance company. And that's its own conversation. That's not what I want to talk about. I want to talk about if you were to use a fixed indexed annuity as a bond alternative, which means you are putting it in your portfolio knowing that it is illiquid for a certain period of time. but it cannot lose money. So a bond fund can lose money. A fixed indexed annuity cannot go backwards. That assumes that you have not added on the riders, fees, and extra benefits that have costs associated with it. Okay. So there's no fee if you get the right annuity, one that has no fees associated with it.
Yeah.
Now, to understand why I believe they have more growth potential over the long term versus a CD or treasury, let's restate again. A CD, fixed rate for a certain period of time. A treasury, a fixed rate for a certain period of time. An annuity, kind of. So here's a really oversimplified explanation of how an annuity could work, a fixed indexed annuity. So let's say you can get a CD or treasury for 1 year at 5.3%. Okay? Roughly what interest rates would be. Interest rates affect fixed index annuities significantly. So let's say that's the going rate, and you've got $100,000 that you're going to put into a fixed index annuity. So let's say then you put in 95% of it, or $95,000 in a fixed portfolio, a fixed product like a treasury earning around 5.3%. In 1 year, that 95% of this alleged portfolio at 5.3% would become 100%.
Okay.
Okay. So you take $95,000 at a rate of 5.3% should grow to $100,000 and change after 1 year of time. Are you with me so far?
Sure. Yeah. Yep.
Okay. So then you have around $5,000 to do something else with it. At that point, you then can go and invest in more sophisticated ways to make money, whether it's options, derivatives, contracts. I mean, you can get more complicated. And because the insurance companies are dealing in larger masses, they can do more things with the money. I don't want to say that's always what they do. This is an example of how it could work. I'm trying to explain the concept here. But if you took your assets and you spent, let's say, 5% in options and derivatives, so if the markets go up, you can exercise that contract and make money. But if the markets go down, you just let it expire, knowing that the 95% becomes 100%. You now have a principal protected system that has more growth potential than the fixed rate itself, assuming that the index that the options and derivatives were based on would have exceeded the assumed rate of a treasury. Are you with me so far?
So if the index doesn't perform as well as it should, the insurance company is still saying you won't lose any money though, right?
Yeah, the 95% becomes 100%, and they let the contracts basically expire.
Okay.
Now, remember, this is an oversimplified explanation of how it kind of works, but do you see how you're taking it strategically, a part of the portfolio based on interest rates, guaranteeing the principal in some sense,
Okay.
because you have fixed rates from things like treasuries that become 100% within a year's time, and the rest is focused on upside potential, more upside potential through very sophisticated instruments.
Okay.
So what that means is the higher interest rates are, the less you would need in fixed investments. So if interest rates were higher, you could maybe allocate 94, 93, 92% to that and have more money to buy more contracts or options in the future to then grow your assets. If interest rates are lower, then it's harder to make as much money. But you always have that greater upside potential if it's structured correctly, if it's based on a reasonable index. I mean, there's a lot of ifs in that statement.
Right.
And that's where the product research comes into play. Some fixed index annuities really, in my opinion, aren't built to make much money. And in that situation, yeah, like the person that's saying, oh, well, I only earn 2%. Yeah, you probably bought a crappy annuity. Sorry to say, but that's probably what happened. I wonder how much due diligence was really done in the annuity, in the index that it's associated with, in the reputation, the renewal rates of the insurance company. Do they promise you, oh, hey, it's going to be, X amount of growth potential, and then in year 2, they just drop the rates? Some companies have a reputation of doing that. Drives me crazy. It goes back to the CD analogy. You can buy a CD at 5% or 0.5% roughly with today's rates. You can buy a fixed index annuity that has more growth potential or less growth potential. It's just, are you doing the due diligence, or is your financial professional, the insurance agent in this situation, doing their due diligence? But because the way a fixed index annuity works as a bond alternative offering principal protection and more growth potential, because it's utilizing options and derivatives and other sophisticated contracts for greater growth potential over the long-term period of time, based on my research and observations, anecdotal and also research, to me, I'm seeing there's more growth potential over the long term than you would get through CDs or treasuries, just because the very foundation of it is they're all tied together. A CD rate, a treasury rate, and an annuity are all tied to interest rates.
Got it.
And so that's where my argument comes into play. They're not all made the same. The research is important, but let's say CDs were offering you 5% right now.
Yeah.
But you don't know what the rates will be in a year from now, so you're taking risk of, if the Fed drops rates, you then have a renewal of a CD, let's say at 2 or 3%. That's a risk you're going to take if you go down the CD route. If you buy treasuries, let's say you buy a treasury for 5 years at 4 to 4.5%. Okay. If you hold that, that's what you're going to get. If rates go up, then you could either hold it or you could sell it. If rates go down, you could hold it, you could sell it. There's some risk associated with it if you sell it earlier, but you still at least have that locked in through the debt security or the debt obligation with the United States Treasury in this situation, that they're going to keep paying those rates, assuming that the government doesn't default. And then you have a fixed index annuity, which, let's say it could offer you, instead of 5 or 4.5%, let's say it could offer you 6 or 7% year over year. That's a couple of percent more growth potential year over year than the other options.
Yeah, I'd take that.
Increasing your growth potential by a couple percent can make a significant difference when it comes to your lifestyle and legacy plan. Should you just do fixed index annuities? No. It may be appropriate for a part of your portfolio. I usually see a blend of CDs, treasuries, and fixed or fixed index annuities to support the plan and the strategies, the efficiency of that plan. But it's not always appropriate.
Yeah.
It just depends on what you are. But I get people who make claims, well, all annuities are bad. Anytime you hear an absolute, be skeptical. There's no such thing as a perfect investment product or strategy. They all have their own individual benefits and detriments. They all offer something unique, and it's understanding how to blend those benefits in a portfolio so that the detriments almost offset themselves. Here's just a simple fact. Next year, the markets are going to go up or they're going to go down. If they go up, you can draw income pretty much anywhere in retirement and you'll probably be okay. But if the markets go down and you draw income from an account that's lost money, you're accentuating those losses. That's how you go backwards in retirement. That's how you really hurt your ability to stay retired. Having a portion of assets in what I call the reservoir, principal guaranteed accounts, allows you, if structured correctly, to draw income from a principal guaranteed source, allowing your other accounts to recover. That's the basis of really what's going on here. And then when you understand that principle, that rule, it's how do you follow that rule and focus on the maximum growth potential throughout the rest of your life. And if you want to learn more about that, text us your questions. We can have a conversation, text or email. So you can text me at 913-363-1234 or email me at heymike@howtoretireontime.com. If you want to see what fixed index annuities could look like in your portfolio, just go to yourwealthanalysis.com. That's yourwealthanalysis.com, or text keyword analysis to 913-363-1234. Look, the reality is I take a neutral position as a fiduciary to do what is best for clients. I'm legally bound to put your interest ahead of my own. Whether a fixed index annuity is right for you or not, whether it's a CD, whether it's a treasury, I'm indifferent about it. It just has to be what is right. And the portfolio must support the plan, and there must be a logical reason for every investment. in a portfolio ambiguity is a real thing, and it happens more often than I think people realize. So request your wealth analysis today. See what it could look like. Just imagine for a moment, you've got roughly the same or potentially more growth potential with less risk. Wouldn't that be kind of nice?
That sounds good to me.
There's no investment that can offer that. These are the only way to achieve an outcome like that is by blending multiple investments in products and strategies together and being very deliberate about the planning. Learn more, see what it's like at yourwealthanalysis.com. Doesn't cost you a dime, but really could open your eyes into your lifestyle and legacy potential moving forward. That's yourwealthanalysis.com. Check it out today. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about your wealth analysis and what it could do for you, regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.